Now, the next part of the lecture that we're going to go through now is how you would analyze a company's leverage. Now, this is kind of things that you would do if you were a bank or if you're an investment house or something like that, and you want to know the extent to which a firm is employing leverage. And again, there are two kinds of leverage: operating leverage and financial leverage. Now, what we use to measure the different sources of leverage now is called the degree of operating leverage, the degree of financial leverage, and the degree of combined leverage. Now, the degree of operating leverage. Now, this is first stage leverage. This is leverage brought about through the use of additional fixed cost. And what you see, this first formulas that you see here now, this is often referred to as the descriptive formulas. It kind of tells you how to interpret the answer that you get, which we'll do here in a few minutes. Now, the degree of operating leverage. There's two kinds of data that we get when we analyze companies. One is accounting data, financial statements and the like, and the other is what we call analyst data. Usually kind of per unit data that analysts like to use, but you'll see they're both really the same thing. If you have accounting data and you want to calculate the degree of operating leverage, the degree of operating leverage is going to be equal to sales minus total variable cost divided by sales minus total variable cost minus fixed cost. Now, you should note here the only difference between the numerator and the denominator is fixed costs, the source of operating leverage. And of course, if the numerator were equal to the denominator, the degree of operating leverage would be 1, which means your next 1% change in sales will give you a 1% change in EBIT. You might remember that unlevered situation I showed you in a previous video. That's what we're talking about. So when talking about operating leverage, what's the lowest degree of operating leverage a company can have? Well, that's the degree of operating leverage if it uses no leverage at all. It's unlevered. It would have a degree of operating leverage of 1. If you had analyst data, this next little formula here, in the numerator it's Q, the number of units produced and sold, multiplied by price per unit minus variable cost per unit. That's analyst kinds of data. In the denominator, Q times price minus variable cost minus fixed cost. Note again, the only difference between the numerator and the denominator is fixed cost. And if fixed costs were 0, the numerator would equal the denominator and your degree of operating leverage would be 1. If you calculated the degree of operating leverage for a company and it turned out to be 2, what that means is that each 1% change in sales will give you a 2% change in EBIT, operating profit. So if sales were going to go up, if you expected sales to go up by 3%, you expect a 6% change in operating profit. Again, the greater this number now, the greater the operating leverage a company's employing. All things being equal now, that's a riskier situation. If your degree of operating leverage is 2, and it turns out that sales goes down by 4%, then your operating profit is going to go down by 8%. That's a bad thing, because what do we have to pay right after we have operating profit? We have to pay the interest on our debt. So if it goes down so far that you can't pay the interest on your debt, of course, you're going to be bankrupt. The other type of leverage is financial leverage. And the way that analysts measure financial leverage with a company now is to calculate what's called the degree of financial leverage. And the degree of financial leverage tells you your percentage change in earnings per share given a 1% change in operating profit. If you have accounting data, in the numerator you would have sales minus total variable cost minus fixed cost. In the denominator, sales minus total variable cost minus fixed cost minus your interest expense minus the pre-tax dollars you need for paying the dividends on your preferred stock. Remember this little preferred dividends divided by 1 minus the tax rate we did in a previous video. Again, that tells you the earnings you need pre-tax to pay the dividends on your preferred stock. And this is how we would calculate the degree of financial leverage if we had financial data. If you had analyst data, unit data, in the numerator you would use Q, the number of units produced and sold, multiplied by price per unit minus variable cost per unit. So in the numerator we're going to have Q times price minus variable cost minus fixed cost. In the denominator, Q times price minus variable cost minus fixed cost minus your interest expense minus the pre-tax dollars you need to pay the dividends on your preferred stock. Now, that's how you calculate the degree of financial leverage. If that turned out to be 3 for a company, that means each 1% change in operating profit would give you a 3% change in earnings per share. So if we expect operating profit to go up 3%, we would expect earnings per share to go up 9%. On the other hand, if operating profit actually goes down 4%, then we would expect earnings per share to actually go down 12%. Again, this leveraged effect, leverage is often referred to kind of as a two-edged sword. You know, it can cut both ways. So this is stuff that's only good if you expect revenue and sales to go up. Now, taking both measures of leverage, operating and financial leverage, together, we refer to that as the degree of combined leverage. And this descriptive formula here tells you that the degree of combined leverage tells you the percentage change in earnings per share given a percentage change in sales. So we're going from the top of the income statement all the way to the bottom, earnings per share. If you have accounting data, the way you calculate the degree of combined leverage, the numerator would be sales minus total variable cost. The denominator, sales minus total variable cost, minus fixed cost, minus your interest expense, minus the pre-tax dollars you need to pay the dividends on your preferred stock. Note, the only difference between the numerator and the denominator is the 3 sources of leverage. Operating leverage, which is fixed cost, and financial leverage, which can be brought about by debt, interest expense, or preferred stock, preferred dividends. If a company uses no leverage, sole proprietorship, mom and pop kind of operation, they probably have no debt, and they probably have no fixed costs, certainly wouldn't have any preferred stock. And what would you have? Well, you'd have a degree of combined leverage of 1, which means that increase your revenue by 6%, your earnings will also go up by 6%. If sales go down 5%, your earnings will go down 5%. It'd be unlevered. As you use more leverage, more operating leverage or more financial leverage, the denominator will get smaller relative to the numerator, and the degree of combined leverage will go up. Again, this is leverage, okay? If you have analyst data, the numerator would be the number of units produced and sold, Q, multiplied by your price per unit minus your variable cost per unit. So the numerator is going to be Q times price minus variable cost. The denominator is going to be Q times price minus variable cost, less fixed cost, less your interest expense, less the pre-tax dollars you need to pay the dividends on your preferred stock. If your degree of combined leverage were 6, that means each 1% change in sales will give you a 6% change in earnings per share. So if sales go up 3%, your earnings per share will go up 18%. A lot of leverage. On the other hand, if your sales go down 4%, your earnings per share go down 24%. The more leverage you have, the more volatility. Volatility can lead to lots of bad financial things. You might note here that the degree of operating leverage times the degree of financial leverage gives you the degree of combined leverage. That is, in this case, 2 times 3 equals 6. That's always true. So when you calculate these various measures of leverage here. At the end, a check for you now is to take your degree of operating leverage, multiply it by your degree of financial leverage. It should multiply out, should equal your degree of combined leverage. Again, this is leverage. We've got a number of other videos to go through to get through with this, but this is how analysts measure leverage. Your degree of operating leverage, your degree of financial leverage, and your degree of combined leverage.